Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. With the COVID-19 stimulus and infrastructure bills increasing debt levels and vaccines now rolling out, we're starting to talk about how to fund all of this new government debt. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss. Phil, before we get into paying the piper, let's discuss the recent retail sales data and the impact the Texas storms had.
Yeah, I mean, it was pretty much expected that the Texas storms and they swept across a lot of the United States would have an impact on the data this month. And we're starting to see it. It's not just retail sales, which actually saw a decline in February, but also industrial production. A lot of the manufacturing indexes have also seen a little bit of a decline in February. And I think broadly, it was expected that there was enough of the economy shut down for a week or two that was going to happen. Retail sales itself, though, is a little bit interesting because you can see in January a huge impact from the checks that went out just before that. And obviously the checks are the $1,400 checks are now in the mail. So the expectation is that March will have another big spike when people get those new checks and start to spend them as well.
And moving to housing data, which has been a bright spot during the pandemic, and of course, with low interest rates, the story seems to be taking a turn after being on a tear over the past year.
Yeah, so I mean, you could say this is kind of similar. Maybe the downturn is because of the Texas storms and the sort of US-wide storms, but really the home builder index has been coming off its highs for a number of months now, and you're starting to see single-family sales, or the house sales in the suburban areas coming down from their highs as well. Still elevated, but you can start to see, I think, a pivot in people's behavior. They're starting to look forward. They're getting the vaccines. They're seeing the vaccines available soon and look forward to summer and doing things, I guess, a bit more normally again in the future as well.
I also think it's interesting because people have refinanced and locked into new mortgages over the past year or two. And I wonder if that's going to hold people back from putting new inventory into the system as well going forward. So I think that's something interesting to watch. But let's take a look at all the debt that has been created as a result of COVID-19. The piper's demanding payment. And the question is, where is this money going to come from?
Yes, and it's a global question, really. So in the US, we're talking about maybe raising corporate rates of tax. Already, we actually have a tax rate that's over the OECD average. Adding to the tax will actually put us, the rate that they're talking about of 28% corporate tax rate would make us look like the most expensive country to do business in. So the tax increases, so UK is talking about increasing taxes as well. One way of paying the debt off. Another is what we call financial repression, where you actually let inflation happen. And so the $100 that we borrow today worth $100. If we see inflation, people might be earning $200, and paying off that $100 is much easier. So financial repression and letting inflation increase is another way of making debt more sustainable. It's something that we're going to have to reckon with, not this year, but in the next few years for sure, especially if rates do keep going up, because obviously paying the interest on the debt is going to become a strain for some governments.
All right, Phil, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.